For the last 2 years, the stock market has been playing a very simple game. It felt like all you had to do was bet on a handful of companies and watch your portfolio grow. They were called the Magnificent Seven: Apple, Microsoft, Amazon, Alphabet, Nvidia, Meta, and Tesla. These tech giants became so powerful, so dominant, that they single-handedly pulled the entire S&P 500 index higher, accounting for the lion's share of its gains. If you have a 401k or an IRA, you have been on this ride, whether you knew it or not. Their success became your success. But what happens when the giants start to stumble? What if the invincible armor is starting to crack? In the background, a series of quiet but persistent signals are starting to flash red. According to an analysis from MarketWatch, several key charts are pointing to a potential breakdown in this tech leadership. The 7 companies that once moved in perfect lockstep are now starting to go their separate ways. Some are still soaring, while others are hitting turbulence. This isn't just a minor dip. It could be the beginning of a fundamental shift in how the market works. It raises a critical question that could define the next year for millions of investors. Are the Magnificent Seven finally breaking up? And what do these warning signs really mean for your money? The story isn't just about a few high-flying stocks. It's about concentration of risk, about market psychology, and about a quiet rotation of money into sectors that most people haven't thought about in years. While the spotlight has been on artificial intelligence and smartphones, a different kind of investment has been gaining ground, signaling that the smartest money in the room may be getting nervous. As we unpack these signals, we'll see that the simple game of just buy tech might be over. The new game could be far more complicated, and understanding the rules is more important than ever. To understand why a potential Magnificent Seven breakup is such a big deal, we first need to talk about market concentration. In simple terms, this is when a very small number of stocks have a huge influence on the entire market's direction. When these few stocks do well, the whole market looks great. But if they do poorly, they can drag everything down with them. And right now, the market is heavily concentrated in these 7 names. So, let's look at the evidence. The first and most important signal, as highlighted by MarketWatch, is the divergence within the group itself. For a long time, good news for one of them was good news for all of them. They rose together as a symbol of tech's unstoppable power. But that's changing. While a company like Nvidia continues to post incredible results driven by the AI boom, others are facing serious headwinds. The unified front is gone. It's now a market of haves and have-nots, even within this elite club. That brings us to the second, and perhaps more telling signal: the rise of the so-called boring stocks. While tech has been grabbing headlines, investors have been quietly moving money into consumer staples. These are defensive stocks, companies that sell things people need regardless of the economic climate, like toothpaste, cleaning supplies, and groceries. When money flows into these types of businesses, it's often seen as a defensive maneuver. It suggests that investors are bracing for economic uncertainty and are looking for safety over spectacular growth. MarketWatch notes that these consumer staple stocks have been on a tear, which is a classic sign of investor anxiety. It's a whisper that suggests the confidence in high-growth tech might be waning. The third layer of complexity is the calendar. We're in a midterm election year, which historically can bring what some analysts call the midterm curse. This isn't a guarantee of anything, but historical data shows that markets tend to experience higher volatility and uncertainty in the months leading up to these elections. It's another element that can make investors favor caution over risk. So you have three distinct pressures building: the internal fracturing of the market's leaders, an external rotation into safer assets, and a calendar year that tends to bring uncertainty. These aren't abstract theories. They are observable shifts in market behavior. The bull case, of course, is that the strongest tech companies will continue to innovate their way to new heights, and this is just a temporary, healthy rotation. The bear case is that these are the early tremors before a larger correction, as the market can no longer rely on a handful of stocks to carry all the weight. So here's what most people are missing. The story isn't that the market is about to crash. The real story is that the game has changed. The era of blindly buying the biggest tech names and expecting guaranteed returns is likely over. The market is becoming smarter, more selective, and more nervous. It's no longer rewarding the entire group. It's carefully picking individual winners and punishing losers. The breakup of the Magnificent Seven isn't an event. It's a process. It's the end of a chapter defined by easy, concentrated growth. And this matters directly to you. If you own a simple S&P 500 index fund in your retirement account, your portfolio's performance has been supercharged by these 7 companies. Their outsized weight in the index meant their gains were your gains. But if that leadership falters, or if the market continues to favor defensive stocks instead, the behavior of your index fund could look very different in the coming year than it did in the last. The momentum that felt so reliable could slow down or even reverse. The next major catalyst will be the upcoming wave of quarterly earnings reports from these very companies. That's when we'll get concrete data. Will the laggards show signs of a turnaround? Or will the divergence between the leaders and the losers become even more extreme? Wall Street will be watching not just the numbers, but the language company executives use to describe the future. Their guidance will set the tone for the market's next move. For years, the market rewarded size above all else. But the charts are telling us a new story is being written. The market doesn't always reward the biggest companies. It rewards the ones that adapt to a changing story.